Hey guys, we're back here for another market review. I actually started recording one earlier and I realized it froze, so I had to start over. Sorry about that. So I'm just going to actually go as fast as I possibly can. First thing I want to do is talk about the model criteria for the BigO model, and let's just jump right into it. And then we'll look at the price action for today, looking for this specific formation to occur. So the first thing, and first and foremost, you must always have some form of liquidity raid that occurs, right? And that can take the form of a previous day high, low, a previous day week, month, higher low, relative equal highs or lows, a short-term swing higher low, and also when you're inside high time frame fair value gaps or volume imbalances, whether it be like a 15-minute, 30-minute, 1 hour, 4 hour, or daily fair value gap. That's when you want to be looking for price to potentially turn in the short term. Doesn't mean it's going to go all the way to the previous day high or low, but looking for specific targets after it occurs. So let's just jump right in. After that, after liquidity is purged, you must, if you were bearish, you want to see 3 consecutive bullish candles. So right here, 1, 2, 3. All right. After that, you want to see displacement with one or more consecutive bearish candles. So after that third bullish candle was formed, we took out Thursday high, right? We pierced it, violated it. 1, 2, 3 bullish candles, and then 1, 2, 3 bearish candles. And then this bearish candle closes underneath the opening price of this bullish candle. So we're going to take that. Once that occurs, we are on alert that we can potentially have a market structure shift, meaning price is now going to start seeing bearish price action. Okay, so um, continuing with that, we must have a fair value gap left behind, preferably inside of these 3 bullish candles. So once price actually closed underneath, this is actually now considered an order block, these 3 candles, meaning basically these 3 candles are going to block price from going any higher. And as you can see, that's what it does, right? So a fair value gap must be formed, preferably inside here, right? So, and also inverse fair value gaps can occur as well. So just to recap real quick, this is the regular fair value gap that is occurring, right? I'm going to drag that out. This is a bearish fair value gap because it's on the sell side. The inverse is actually on this side. So originally, this was, you know, considered a bullish fair value gap. Okay. Man, where did it go? That's not cool. Try one more time. So it's an inverse fair value gap. Okay. So originally it was bullish, right? So you would expect price to come inside the bullish fair value and then push up. But because price went all the way through it, now it's no longer a bullish fair value gap. It's an inverse fair value gap. So it could be utilized to go short. So we actually have 2 things. We have a fair value gap inside here, a bearish fair value gap, and then we also have the inverse. So if you take that across both of them, eventually price comes back into it, right, and pushes away. So if you were going to go short here, conservative entry is, at 50%. Your stop loss would be at the swing high of the candle that first started the fair value gap, right? Because this is the first candle, all right? And then, I'm a scalper, so I usually exit at the nearest swing low. But if you have some obvious, longer term targets to the downside, then aim for those. But once you enter here, you can exit right here or exit, try to hold for this swing low, whatever your tolerance is. And again, if there's a much deeper target that you think it can reach, then you just wait for it to get in there. So this is actually right here, the perfect setup. This is what it looks like. This is exactly what the bill model looks like. It's a funny name, but it is what it is. Um, so exactly like this. These three up close, it could have been four, it could have been five, it could have been 10. I don't care. But so long as we have, the multiple candles closing consecutively underneath. So we need a minimum of three, and that's what we have. So with that being said, that kind of covers the model. All right, so let's jump over to today's price action and just review where this model occurred. So we're going to go to the other tab. All right. This was the opening price here, 6 o'clock. So I'm just going to go really quick. And then maybe we can review. Actually, I can close that right there. All right, so right here is a good example of a short one. Okay. So we have our criteria here. We have one. So we recently took out this swing high right here, right? Took that out. We have three bearish candles, or bullish candles, I'm sorry, and then three bearish. We have fair value gap that was left behind. All right. Price hit right dead center. And then we also have the inverse. Let's draw that out again. All right. So price barely tapped my one tick inside the inverse fair value gap. And the center of this fair value gap. So real quick, if you're going to take an entry, the earliest you could take an entry is at the opening price of this first candle. So if you notice, this fair value gap, the regular one, just delete that, is both, like, half of it is outside of these candles and the other half is inside these candles. So your entry should be no earlier than the opening price wherever the market shift occurred. So this is the market structure shift that occurred. That's the earliest you would want to go short. So right here, stop loss will be up here, and your take profit would be near swing low. So if we got in there, all right, so if we got in there, your near swing low should be down here, 110. Okay. So we took out a short-term swing high. Now this swing high is higher than this one. However, what I don't like, I would have liked for it to come up here, but here's something you need to consider when you're looking at this. So yes, we did take out a short-term swing high right here, right, as we came up. Obviously, like this would have been a good target, right? We have relative equal highs because this one is, relative equal to this one. This one did not pierce it, so now we have relative equal highs, right? However, because price didn't get up here and the model occurred before getting up here, that means that because it failed, that means it was weak to get up there, and also we took out this short-term high, so you can trust this one to go short. If this would have not have taken any form of short-term high, like let's say it came from here and then occurred, and then this happened, like just pretend this was just like a straight shot up with no swing high like this, then I wouldn't have trusted this to go down. I would have wanted to wait until this got taken over, but it didn't. So what why you should trust this one is because of this short-term high, swing high that was violated, even though it didn't take out these relative equal highs. But if it would have, and then this occurred up here, well then yeah, I'm still gonna go short. Okay, so there's one example in the London session. And then again, it occurs again right here. There's 1, 2, 3. It didn't take out any like obvious swing high, right? It actually went into the first BigO model and continued down. So I like seeing this, right? Because we have the 3 up and then 3 down. I like seeing this as like this is more confirmation that it can actually go lower. So, and obviously it does for the day. We had news come out and it just basically nosedived, right? All the way down into the Friday's low and the daily fair value gap that I had annotated earlier. So, and it's funny because here we see the model again. We did take out some form of short term, actually, but here's the thing, like just because we see this here, well, there's a couple things missing. So we do have 4 and then 2 down closed underneath, right? But what's missing is that there's no fair value gap, like no bearish fair value gap inside these 3 or inside these 4 bullish candles. There is a small little tiny inverse fair value gap right there, but that's not really significant enough to be able to trust to hold price down. So there's 2 things against it. One, there's no bearish fair value gap inside these, right? So I would want to see it somewhere right here. It is down here, but that doesn't trust me that it's going to hold. I want to see it somewhere up here. So there's one thing that against it. We have an inverse, but it's really tiny, not very like trustworthy. So that's a strike against it. 2, the third thing is even though you see this formation, we did take out the intermediate swing high here, but even though you see this here, we are in a discount. So why would you short from a discount, right? I mean, we were just a couple minutes ago way up here. Why would you short down here? And so you always need to tell yourself, where am I when you're looking for this model? Like relative to where I was, an hour ago, where am I now, right? And so if we came from up here and then the formation occurred down here, it's too late to short. We're deep in discount. So that doesn't mean it can't keep going down, but I wouldn't trust it at this point. So because it didn't meet various criteria, then this is no longer valid to go anywhere short inside of here. Okay, so just keep that in mind. So then let's keep going throughout the day. See if we see it again. We see it again right here. Okay. So we have one. This is to the bullish side. So we have one, two, three bearish candles, and then one, two, three closing above that candle, the opening price of the first bearish candle. All right, so we have a shift in market structure. 5 minute. We do have a fair value gap. Some of it is outside of the bearish candle here, and then the majority of it is inside. We do have an inverse, however, as you can see, price never even came back into this area, so you would have just missed out. Now, at some point later on, it will come back. It's going to come back, it's going to go in these areas, and it's going to reject temporarily, retrace back up, because that's what it does. You'll start to notice that. That's what it does. So it goes from like one BigO model to the other, and then later on it'll come back, and it'll come in here and then reject, grab some more orders to go along, and then finally slam down and violate the whole thing. But anyway, there's the model, except price just never came back. So there you go. And then up here, there's really nothing. So there's a couple examples of the 5 minute. Let's look at some where they kind of looked good, but didn't quite work out. So here's one where it looked pretty good, right? So we have the 4 and then 3. There is no fair value gap left behind, and there's also no inverse fair value gap. So let's zoom in so you guys can kind of see that, right? There's no inverse on this side, and oh wait, yeah, there's one right here. There's one fair value gap. Had to zoom in and really stretch it out, and it does hit. Okay. Now, the only thing is, again, I wouldn't have trusted this because this did not take out any swing low. I mean, do you see the swing low here? No. So I wouldn't have trusted that. And if you were going to take this long, and you did notice that this fair value gap right here, okay, go for it, right? Your entry should be right here, 50%. Your stop loss is going to be right there, right? And then you would be aiming for um, an obvious swing high to be taken, right? So if you entered here, either right here real quick or this here, but as you can see, it failed to reach it and ultimately comes back against you. And if you did hopefully take something out here, then you would have got stopped out right there. Okay. See down here, do we have anything here? There's kind of one here, but really no fair value gap left behind anyway. No inverse, so you would not have been able to trust this one. And it didn't really take out any major swing high or intermediate swing high, right? So that wouldn't really count. All right, so let's go to 1 minute, because I actually look for it on the 5 and the 1 minute. So on the 1 minute, down here, all right, okay, so there's this was the target this morning, right? So as we came down, let's go up here, see if we saw anything. Actually, I think in my previous video, I talked about the big O happening here. So from one day to the other, did it close? Yeah, it did. So right here was actually the big O model that played out. So we closed up here for Tuesday, opened up down here, and we closed underneath this first bullish candle. And I mentioned that this gap should be considered as a continuation of the bearish candles, right? So not only is this gap a continuation, but also it's a liquidity void where no trading has occurred. You treat it as a fair value gap, go short inside, right? And target your near swing low. So down here would have been the target, or this swing low down here, but you can see it actually goes lower. But if you want it to be in and out, there it is. Same model. Remember I said it can be 3 or more. In this case we have 1, 2, 3, 4, 5, 6, 7, 8. And then 1, 2, 3, 4 closing underneath the opening price. We took out an intermediate swing high right here, right? So we rated liquidity, short-term high, displaced, fair value gap left behind, go short. This is on the 1 minute. All right. So we keep looking. Here, you know, this times where you would have probably got tricked, right? But here, we didn't really take out, you know, this swing low, didn't quite take it out, right? We have 3 bearish, 1, 2, 3, 4 bullish. We do have a couple fair value gaps, but again, this didn't really take out any major swing low, or even a short term. I mean, this one is, I guess, sort of one, but you know, it's just, you know, it's not as obvious as the other one we just saw, so that wouldn't be too clear. But let's go down to, you can go check these out on your own, study them, but I really want to go down to where I actually took an entry here this morning. And so all this news, I woke up like at 8, all this news had occurred. It was just nosediving, you know. My old me would have chased this and then, you know, maybe been successful, or it would have came against me. But anyway, so remember the criteria is we wait for a swing low or previous day high or low, fair value gap to go long or short, right? In this case, we went long. So I waited right here. We almost took Monday low. We took Monday low here, but I didn't see any sign of our specific formation to occur, right? And here's this one to the downside, but this swing high didn't actually take out that swing high. So even though it occurs here, you know, I'm not going to trust it to go short if it came back, right? Which it did, but it blew right through it. So I waited. Friday low got hit. We dove into the daily fair value gap. And again, we're just still waiting. We're still waiting until our model appears to go long. And lo and behold, right at 10 o'clock, at 9:59 was the start. So we got down here, 9:59, first candle, right? This is what started the shift in market structure. So we have 1, 2, 3, right? We took out intermediate swing low, short-term low. So not only did we take that, but we took out Friday, we took out the daily fair value gap, short-term low, One, two, three bearish candles. One, two, three bullish. We close above the opening price. This is the 1 minute market structure shift. We leave behind a fair value gap right here. I had a limit order here, which is waiting. Got in a couple contracts. I knew this was going to take off, being also it being 10 o'clock, and I knew that I had to be aggressive here. So once this candle crossed this wick here and into the fair value gap, I immediately just hit a market order. I didn't wait, and anytime it crossed into it, I hit it again. I think I got like 3 contracts in here. So not only do we have a fair value gap here, but we also have the inverse fair value gap on the other side. So there you go. Inverse fair value gap. So in the inverse fair value gap, it actually does hit 50%, and then the upper portion of the inverse fair value gap. So either one is okay to trade on. So if you were going to take the inverse, well, we'd have got a bullseye, right? Your stop loss would have been down here, and your take profit would have been up here. Man, what is going on with my mouse? Take profit would have been at the first swing high, which is the buy side liquidity right here. I took one off here. Or if you're really feeling you can go longer, relative equal highs right up here with just one contract. 3,185. See that? Remember, this is the same exact criteria that I had annotated at the beginning of the video. So go back and study this. Right? Go look for these specific formations, and you'll be surprised how often they occur. And also, these formations occur on the sub 1 minute. So they can occur on the 30-second, 15-second, 5-second. I enter on those. I enter on the 5 seconds. So go back and study those time frames if you have them. But I really wanted to show you that this model prints like crazy. It can happen on the 2 minute, it can happen on the 3 minute, but that criteria must be there. And with that being said, I mean, we're going on 30 minutes on the video. I'm going to go ahead and cut it here. There are more examples, but I don't want to sit here all day. The first video on me just froze, so we're going to cut it here. But anyway, hopefully this helps describe the model, and you too can go study it, and start paper trading it until you get comfortable using it. So with that being said, I hope you all have a good night. And if you have any questions, please, put it in the comments, like the video, subscribe, so I can kind of help me make more videos and stay motivated. But with that being said, we'll talk later. Thanks.